Hello, everyone. Thank you for joining us for our weekly investment brief. I'm Tony Welch, Chief Investment Officer at Signature FD. So today I want to focus on five developments that are shaping markets right now. First, the trend remains firmly positive. Second, we're beginning to see signs of broader market participation. Third, earnings continue to surprise to the upside. Fourth, inflation remains one of the primary risks that investors should monitor. And finally, we'll discuss what the successful SpaceX IPO may be telling us about investor sentiment. So let's begin with a quick look at market performance. At the headline level, it was another constructive week for investors. The S&P 500 gained about 70 basis points, while developed international markets rose roughly 1%. Bonds were also positive, with the aggregate bond index gaining about a half a percent. What really stood out, however, was the shift in market leadership. Small caps led the way with the Russell 2000 gaining nearly 4% during the week, and value stocks gained 2.5%, while growth stocks actually declined nearly 1%. At the same time, commodities and energy posted pretty sharp declines, with the energy index falling nearly 7%. So, this is notable because it represents a very different leadership profile than what investors have become accustomed to over the past several years. So, for much of this cycle, a narrow group of large cap growth companies has dominated returns. Last week's market action suggested that participation may be beginning to broaden out. So, turning to the technical backdrop, the evidence does still remain constructive. Ned Davis Research continues to view the primary trend as firmly positive, and this chart from them shows the 50-day moving average did remain above the 200-day moving average throughout the volatility surrounding the Middle East developments and has recently begun accelerating away from it once again. So, this is an important point because trends tend to matter more than headlines. Markets are constantly presented with reasons to worry: geopolitical conflicts, inflation concerns, policy uncertainty, recession fears. They all compete for investors' attention. Yet, despite those concerns, the market continues to exhibit many of the characteristics associated with healthy uptrends. As long as the trends remain intact, we believe investors should continue giving the bull market the benefit of the doubt. Now, one of the more encouraging developments recently has been improving market breadth. For much of the last 2 years, market gains have really been concentrated among a relatively small number of those mega cap tech and AI related companies. While those companies remain important, we're beginning to see signs that participation is broadening out. So, Ned Davis Research has a breadth indicator here that shows that nearly 70% of sub industries now exhibit bullish momentum or are in a bull market. And that's an improvement from just a week ago. So, this broadening helps explain some of the leadership changes we discussed on the prior slide. Small caps outperformed and value outperformed growth, and international markets continue to participate. And this is resulting in better market breadth readings. And historically, some of the healthiest bull markets are characterized not by a handful of winners carrying the market, but by broader participation across sectors, industries, and company sizes. So it's still early, but these are encouraging developments. And the fundamental backdrop remains equally supportive. So, according to FactSet, second quarter earnings are now expected to grow by nearly 22% year over year. If realized, that would represent another exceptionally strong quarter for corporate America. What's particularly impressive is that analysts have been revising earnings estimates higher throughout the quarter. Historically, estimates tend to drift lower as reporting season approaches, but companies guide conservatively and analysts adjust expectations downward, and earnings eventually clear a lower hurdle. This quarter has looked different. Instead of lowering expectations, analysts have been raising them. So, strong earnings growth remains one of the most important supports for higher stock prices. While valuation discussions often dominate financial headlines, over the long run, earnings growth is ultimately the driver of market returns. So for now, the earnings picture remains remarkably healthy. Now, while the earnings story is encouraging, inflation remains one of the primary risks that we're monitoring. So last week, we received inflation reports that were firmer than policymakers would prefer. Consumer prices rose 4.2% year over year, and producer prices increased 6.5%. So those readings are not necessarily alarming, but they do remind us that inflation has not fully disappeared. The good news is that energy prices declined meaningfully during the week last week. Falling energy prices provide some relief for consumers and businesses and may help to keep inflation expectations anchored. Our base case remains that the Federal Reserve is going to have to stay on hold, but they're not going to have to move towards additional tightening. However, inflation does remain the variable that's most capable of changing that outlook. If inflation continues to moderate, the Fed can remain patient. If inflation pressures begin accelerating again, policymakers may face more difficult decisions. For now, we continue to view inflation as a risk worth monitoring rather than a reason to get defensive or expect some form of a recession. Finally, the successful debut of SpaceX last week is important, but not necessarily because of SpaceX itself. Instead, it may tell us something about investor psychology. Historically, large IPO waves tend to occur after periods of strong market performance, rising valuations, and growing investor confidence. In other words, IPO booms are often a symptom of optimism rather than a cause of future market weakness. And that's an important distinction. Strong IPO activity generally reflects healthy capital markets, abundant investor demand, and confidence in future growth prospects. And those are not inherently negative developments. However, rising optimism, it does have implications. When expectations become elevated, markets often become more sensitive to disappointments. Earnings misses matter more. Inflation surprises matter more. Policy mistakes matter more. Much of the pessimism generated during the March correction has already been worked off. Investor sentiment has improved significantly from that low, and the successful SpaceX offering is likely to reinforce that trend. So the takeaway isn't that investors should become bearish, but it is a reminder that fundamentals become increasingly important as those expectations rise. So as we wrap up, three thoughts here stand out. First, the weight of the evidence remains positive. Earnings growth continues to surprise to the upside, market trends remain constructive, breadth is beginning to improve, and economic activity continues to support expansion rather than contraction. Second, inflation does remain a key risk that we're watching. Recent inflation reports remind us that inflation has not been fully defeated. Falling energy prices have provided some relief, but we'll continue monitoring inflation expectations and labor market conditions closely. Now, finally, investor optimism is clearly increasing. The successful SpaceX IPO is just one example, but it's really part of a broader trend. Investors are becoming more confident. Capital markets remain healthy, and risk appetite has improved considerably since the March lows. And that's generally supportive for markets, but it also means expectations are rising. As a result, future returns are likely to depend more on earnings growth and economic fundamentals than on investors simply paying higher prices for stocks. Taken together, we continue to believe that the evidence supports staying invested and participating in the uptrend while remaining mindful of inflation risks and elevated expectations. So that's what we have for you. I want to thank you for joining us. And as always, I would like to wish you a great week ahead.